It's time to bring back in Tom McClellan. So good to have you here with us today.
I'm glad to be here with you. Hopefully you have some fun charts that people will like. I got a ton of them, so we'll try to get through all of them. Yes, autumn is here, and we've been waiting for a long time for it. I'm going to review my top secret indicator here. This is Euro dollar commitment of traders data. It's from the COT report published by the CFTC, and it's looking at the net position of the commercial traders, they're the big money banks, in euro dollar futures. And what we find is that the movements of this data tend to get echoed a year later in the stock market. So what I've done is I've pushed this red line forward by a year to reveal how when you see a big decline in that data, you get a big decline in the stock market a year later. So we've been focused on a big peak early in 2018, a big summer decline, and then the big rebound in the fall. That's the agenda. Hasn't worked out exactly like that. Let me zoom in a little bit. This is the same relationship. The red line is pushed forward by a year, and we got our March top pretty much on schedule. But wait, where was the bear market in the summertime? What happened to the S&P 500? It just kept on trending higher. Well, it turns out we did get our summertime bear market, just not in the U.S. stock market. Here, for example, is the Brazil Bovespa index, and it declined on schedule, seems to be rebounding on schedule. Here is the emerging markets ETF, EEM, topped right on schedule in March with a little wildness in January to precede it, fell right on schedule. So the rest of the world saw the summer decline like it was supposed to, and it seems to be turning up for the autumn just like it's supposed to. Here's another one. This is the MSCI World Index minus the U.S. They take the U.S. out of it and just put the entire rest of the world into it. And sure enough, it had the weakness in the summer like it was supposed to, and it appears to be bottoming and turning up on schedule. So why was it that the U.S. market failed to respond to the illiquidity event that this leading indicator told us about? Well, here's one answer, courtesy of a study just released by the Federal Reserve. They looked at S&P 500 companies, and all 500 of them, which must have been a Herculean task to do computations, and looked at what the rate of repatriation back into the U.S. from their offshore profits is. And you can see that for most of the time, it's relatively low and static. But then once we got the tax law change and going into effect in the first quarter, boom, look at all that, $313 billion coming back from overseas banks into the U.S. And that money had to go to work somewhere, so it's gone to work helping the U.S. stock market. To put that $313 billion first quarter figure into perspective, that's 3 months. That's a little over $100 billion per month. Per perspective, back in QE3, the Fed was pumping in $85 billion a month. So we basically had a QE4 courtesy of all that money coming back to the U.S. It tapered off a little bit in the second quarter because they got it all done in the first quarter, but it's still happening at more than twice the natural background rate. And so all that money coming into the U.S. and leaving foreign banks has a predictable effect on the relative performance of the U.S. versus the rest of the world. We're in the second year of a presidential term, almost about to enter the third year, and I count those years as starting November 1st because that's when the election takes place. And this is my presidential cycle pattern. It's calculated by taking the S&P 500 price history, chopping it up into 4-year blocks of time and averaging their performance together. So this is what the average performance looks like of the S&P 500 over the 4 years of a presidential term. And that most people know the first 2 years are generally sideways. You don't make much progress generally in the first 2 years. The third year is really strong up. And then the fourth year is also strong, also up, but not nearly as strongly because people start worrying about the election. Well, this is what the S&P 500 has actually done. We're setting both of them back to an initial starting value of 1, just so we can see what the relative performance is. We seem to have pulled forward a lot of the third year gains into the second year by bringing all that money home and pushing the U.S. stock market up. So then the question is, do we get this big third year upturn like the presidential cycle says and like the Eurodollar magic indicator says, or have we already had those gains? And that's a good question. We're turning into annual seasonality. This is the same idea. We're looking at the annual seasonal pattern instead of the 4-year seasonal pattern. You chop up the data into 1-year chunks of time and average them together, and that's what the average annual seasonality looks like. It didn't work too well at the beginning of 2018 because we had this big blow off in January, the short VIX squeeze that had a little crash in February. But then as we got to the middle of the year, it started correlating better, but with an interesting twist. There was a little bit of a lag. So the bottom was supposed to be here, but it actually occurred about a week later. And the bottom was supposed to be here. It actually came about a week later. We're seeing that as the pattern plays out. The stock market has been trending higher instead of lower like the pattern says. So that's a big difference, but the dance steps are still there. So here's where the seasonal pattern says the bottom is supposed to be, which is September 24th. If we continue with this 1 week lag that we've been doing, that means we get our bottom somewhere around here due October 1st. It's still the same bottom. It's just, it's doing the same dance steps a week late. And then the seasonal pattern turns up. We'll see if we can get to do that. There are some problems though, because we're not seeing strength matching the stock market strength in the high yield bond market. If you look at measures like HYG or HIO, high yield ETFs, some of those are still doing okay, but they are dominated by some of the larger cap issues. This is an advanced decline line for corporate high yield bonds. It's data that's kept by FINRA, and I access it every day, and I have to go fetch it one day at a time because they don't make it available in a time series. But it's such good data that it's worth doing it. We're seeing attempted to make a breakout to join the stocks, but that's kind of failing. It's got a divergent lower high compared to higher high in stock prices, much like what we saw back in January. That's a problem. It says that the most liquidity sensitive issues, the high yield bonds, they're not participating in the party. All the liquidity is going to lifting the large cap stocks. So that can be a problem. It could get resolved if this starts performing better. That could resolve the liquidity problem that this is warning about. But for now, it's a concern. We're seeing a similar advanced decline line divergence in the New York Stock Exchange advanced decline line. It looks at every stock on the NYSE, how many of them are going up versus how many of them are going down every day, and you calculate that on a cumulative basis. When you see divergences like this, that's a warning that liquidity is becoming a problem. The big guys are able to garner their share of the liquidity, but the little ones that populate most of the list are not doing as well, and that can be a big source of concern. And that's different from what we've seen throughout all of 2018, where the advanced decline line was acting strong and saying that things were good. It's saying there are problems now. And that weakness in the advanced decline numbers shows up in the McClellan oscillator, still negative. It refused to go up above zero as the New York composite was making higher highs. That's not a positive sign. It's forming a complex structure below zero, and the complex structures indicate which side has the strength. We got a conflicting message from having a complex structure above zero, which said that the bulls were strong, but now the complex structure below zero says the bears are in charge until further notice. We're also seeing a divergence in the number of NYSE issues making new 52-week highs. Prices are making higher highs. This is making lower highs. That's not generally good news because it says there's waning participation among the masses in the uptrend. Now, not all divergences like that have to matter. Back here in 2017, we had a couple of good-looking divergences just like that, but they got rehabilitated. They got off the Group W bench that Arlo Guthrie told us about and saw a higher high, and so then the problem was resolved. But when you have a big divergence like we saw in January, not making higher highs as prices do, that is a warning of a problem. Doesn't have to mean calamity, but it's telling you something's wrong. We're speaking of new highs, we're also seeing episodes of the Hindenburg omen. And that's an indicator created, or it's a signal created by the late Jim Mika as a modification of Gerald Appel's old signal called the split market sell signal. Gerald Appel years ago wrote about how it was a problem if you saw both new highs and new lows exceed 45 issues on the same day. Well, that was never adjusted for the increase in the number of issues, so Jim Mika took it and ran with it and quantified it a little bit differently, added some other filtering criteria to create the Hindenburg omen. Now, the criteria that I use are as Jim Mika published them. He's not around to answer for it, but he told this to Greg Morris in Greg Morris's book, The Complete Guide to Breadth Indicators. You'll see different criteria around if you go to different websites, because Wikipedia says different criteria, and you can't argue with Wikipedia because it's always true. But these are the criteria for this signal that Jim Mika came up with. Interestingly, when you get a single signal, it doesn't usually matter as much as if you get a cluster of them all together. And the more you have, the more interesting it is. We're so far at 10 and counting on this current cluster. We had 5 back in January and February, which was a pretty good indication of a top. But we also, in late 2017, we had a cluster of 7 of them, and that didn't turn into any calamity. The signal remains in effect as long as the McClellan oscillator is negative. That's the third criteria. As soon as the McClellan oscillator goes above 0, then the signal's canceled and you move on. But Jesse Felder of the Felder Report did some interesting analysis. He came up with this indicator that I've replicated. He counts the number of Hindenburg-Omen signals over the past 6 months. And when you get really high totals, it tends to be more significant. It didn't matter at the moment right then in this instance in 2006, but you got another spike in late 2007 or early 2008. We saw a big spike. That was the all-time record of 12 of them in 6 months occurred at the top in January, and now we're up to 10 and counting. So it's a little bit of a concern. There's other reason for concern. Some data that's put out by Investors Business Daily. They look at the premiums being paid on puts versus calls, and we smooth that with a 5-day moving average. That's up a really high. It means that people are much more interested in paying up for call options because they think that the market's going to continue going higher. And when you get high readings like this in the past, that tends to be associated with tops. And what high is can vary over time. Here's an example of high, but we're forging new territory in terms of what high means. And so sentiment is a bit of a problem, in addition to liquidity being a problem. And IBD's short interest indicator is also up at a very high level. It doesn't always have to matter, as we saw in 2017 when there was lots of liquidity pushing the market higher. But generally speaking, when you get one of these big peaks, it tends to matter. So this is one of the difficulties that the stock market's going to have in continuing to push higher into the autumn like it's supposed to. I'm not sure how that's going to get resolved. I think that for the next week or so, until about October 1st, we're vulnerable to a big drop. After that, a little bit less vulnerable, but I'm not going to be boldly courageous and bet that the autumn rally that I've been anticipating is going to take off until I start seeing some more confirming signs and elsewhere in the stock market. Switching gears, I want to talk about precious metals a little bit. Here's a chart of December futures for silver. And ever since blow off top in June, it's been making this stair-step pattern. It happened sharp drop, go sideways, sharp drop, go sideways. That has persisted, and it was continuing earlier this month, but now that's changed. Now we've broken out higher out of this go sideways range and broken a downtrend line. So whether this is a another blow off or a fake out, we don't know, but it's certainly something different is happening than what used to be happening, and that's got my attention. Whether silver can go higher, it probably depends on whether gold can go higher, because the two are joined, and silver can wander a little bit on its own, but if gold doesn't join, then they're probably not going to go very far. And what we found recently is that the price of gold, measured in dollars, tends to be strongly tied to the exchange rate of the Chinese yuan. Here's a comparison of the two, and the correlation is pretty obvious, at least this year. And so only if the yuan exchange rate is going to get allowed to go higher can we expect that gold will also be allowed to go higher. If China keeps it going sideways, then gold is likely to continue going sideways as well. This is an interesting relationship because it hasn't always been the case. It's really just in the last couple of years that it started correlating so closely. And I like this chart because the place where this big drop in the yuan decided to stop was right at the level of an apex of a symmetrical triangle back in early 2017. Most people who look at triangles don't pay attention to the level of the apex, but I find it's very important. An apex can matter in terms of time because it can mark a top, or it can measure in terms of price as forming a new support resistance level where it had not existed before, and it sure enough came in and stopped right there. It was also an important level on an even longer term basis because way back in 2008 to 2010, the Chinese central bank held the yuan relatively fixed for a couple years. So they really, really liked that level, and it was allowed to wander for a while. Came back to it, wandered for a while, but came back to it. So somebody in China really thinks that this is an important level that the yuan should be at compared to the dollar, and they've managed to make it happen again. As the yuan has come back to revisit that same level, that's happening as gold is coming back to revisit the top side of its broken downtrend line dating back to the 2011 top, which makes it further interesting. Gold is further interesting this week because we had a full moon on Monday, and years ago I set about trying to prove that it was not true that the full moon schedule mattered for gold, as some people were asserting, and I failed in that proof, or that disproof. It really does tend to matter. You see, when you have a full moon, that tends to mark a turning point for gold. Sometimes it's a top, sometimes it's a bottom, sometimes it's an acceleration point. And so you don't know what sort of significance you're going to have until it's upon you. And that's going to be really frustrating because, okay, I can look at what the full moon schedule is for the next 200 years, but what sort of significance it's going to have, you don't know. At the same time in this chart, there is an independent and separate 26 trading day turning point pattern in gold prices. So about every 26 trading days, you get one of these turning points indicated by the red arrows. Sometimes it's a bottom, sometimes it's a top. You don't know what it's going to be. Interestingly, this time, we have a confluence of both of those factors at the same time. So it's like two different cycles are teaming up to say that this should be a really important turning point. Hasn't happened yet so far this week. Gold is remaining stable and quiet, but give it another week and we'll see what happens. I think that gold should start heading higher. That's my bias in how to interpret this signal. All this says is turning point of some kind, but you don't know what kind. My bias that gold should go higher comes from looking at some more data from the Commitment of Traders report. We saw last week, for the first time, the commercial traders of gold futures have gone actually to a net long position for the first time since 2001. Most of the time, they are at varying degrees of net short, but for the first time, they are net long as a group. The bias toward the short side that they show, it happens for a natural reason. A lot of gold producers fit into the commercial trader category, and when a gold producer sells its future production, it becomes short. It's long the gold that's in the ground, but it's short the contract to deliver the gold next December. And so when you see this happen, that they're no longer net short, they're actually back to neutral, that's saying that they're looking at this price and they don't want to sell their future production at this price. They'd rather wait for a better opportunity. The guys who produce gold, who are smart about gold prices and know what's going on in the gold market, they're saying, no, this is not a good price to sell at. We'd rather not sell our gold, and we'd rather wait for something better to happen. And that tends to be important. It tends to be a marker of an important low, like we saw in late 2015 or the lows of 2013. So this has got me very excited about the prospects for gold. Here's same sort of indication. First time ever in history of the Commitment of Traders data, we're seeing the silver futures net long as a group. First time ever. So that's got to mean something. They're saying that this is not a good price at which to sell. So they don't want to sell. And usually they're net short to varying degrees, but now they're net long for the first time in history, and that's got my attention. At the same time, the commercial traders of dollar index futures are net short in a big way, like they were back in 2017, or like they were back in 2015 and 16 when the dollar was making peaks. So I'm thinking that this means that we're seeing a big broadened peak in the dollar, and that they're going to be proven right in their short position in the dollar index futures. A declining dollar index should mean some support for gold prices and for other commodities prices. May not be good for other things, but it should be helpful to U.S. trade. And finally, in the commodities area, this is my leading indicator for crude oil prices, and it's found by taking the price plot of gold prices, shifting it forward by 20 months. So this low in crude oil was the echo of a low 20 months earlier in gold prices. We saw similar echoes. That's the same dance steps showing up again and again. Gold prices 20 months ago and beyond, we're in a choppy uptrend. So that's my expectation, is that we're going to see a similar choppy uptrend for oil prices into 2019, but then it should start going down again to echo gold's decline once we get into early 2020. So to close, I'll remind everybody, if you want to learn more about our indicators, you can come to our website, sign up for one of our newsletters. We also have a free weekly chart in focus. That article is just I pick a chart or an indicator and talk about it. You can sign up for free, no strings attached. We won't ever spam you. We won't sell our list to anybody. We just believe that that's the right thing to do. But it's a way to get more people acquainted with our indicators. And with that, Aaron, I'll turn it back to you if there are any questions you'd like to go back and see your chart and review it.
All right. Well, let's see. As far as the chat room, one of the topics is the dollar. And, you're talking about gold doing well. And, one of the things that they were mentioning, and I think it's a good question, is that, generally when you see the U.S. rates start to rise, the dollar tends to get stronger. And right now it's getting weaker. What do you make of that? And I know that if we do end up with a weak dollar, we should expect, gold to do better. What are your thoughts on that?
Yeah. Well, my first thought is I tend to trust the experts, and these guys are who my experts are, the commercial traders. They're saying that despite the factors that you just mentioned, they would rather be short the dollar in a huge way. So they must know something. The other part of it is that, yes, U.S. rates could rise, but other rates like Japan's or Germany's, those could rise even more and make their own debt more worth investing in than sending their money to invest in the U.S. Treasury debt. So that would be part of the answer. I don't have a good macro answer from knowing what the entirety of the world is going to do. I just look at who's the smart money and how are they betting, and that's where I take my guidance from.
Absolutely.
Hey, I got a follow-up question there, Tom. Because obviously when the dollar's doing something, you expect the opposite from gold. But I'd look at it even a little bit differently. I mean, I think since the dollar bottomed about 6-7 years ago, the problem with gold, in my view, is that it has continued to underperform the S&P 500. So even when we have seen some bounces, they've been very temporary in gold. And relative to the S&P 500, those bounces have been very minimal and have quickly been erased. So I guess a question, because the dollar, even during a period of a lot of weakness, I mean, we've seen it just recently, but throughout 2017, we really didn't see the huge bounce in gold, given the significant drop that we saw in the dollar. So I'm just curious, because everything you invest in, there's always you've got other choices to make. Do you want to invest in gold? Do you want to invest in something else? And I know the gold versus the S&P 500 ratio, literally since late March this year, has been going straight down. It's like a ski slope. So while the dollar has still been weak, the gold still doesn't seem to be gaining anything relative to the S&P 500. So one question, I guess, is whether or not to get into gold. But then another question is, even if you like gold, do you like the S&P 500 more? And based on the third year of the presidential cycle, the fourth year of the presidential cycle, have you decided in your own mind which of these you think is a better investment? Is it gold based on what you're seeing on some of the charts that you've just shown us, or is it the S&P 500, which has been clearly outperforming most of the rest of the world, and now we're heading into that year 3 and 4? Just kind of your thoughts on what you think in terms of the relativity of those two investments.
That's a great question, but I will remind everybody what I started out with talking about gold. If you believe that gold is going to go higher, as the smart money says, then you have to believe that the yuan is going to go higher. And thus you have to believe that China is going to allow the yuan to go higher. And that's a tough belief system to try to get my mind around, because China tends to like to put its thumb on the scale in a big way. And so that could be the real flaw in any analysis about what gold should do. Gold has stopped going down for sure and gone sideways, but it hasn't really turned up like it's supposed to. So that's China may be keeping its thumb on the scale and interfering with any great calls that any of us might make about what gold should do. But your other part of your question was about the performance of stocks versus gold, and we've looked at that going back all the way to the beginning of the stock market in the 1700s. And what we find is that the the Dow to gold ratio or the S&P 500 to gold ratio, that tends to move with consumer confidence. And we're hearing record readings or multi-year record readings for consumer confidence indexes like the University of Michigan or the Conference Board. They're saying that the consumer is very, very confident in the economy and in their own personal economic situation. When that happens, they tend to invest more in the stock market. When consumer confidence is falling, then you'll see a underperformance of the stock market versus gold, or saying that another way, you'll see outperformance of gold versus the stock market in times when consumer confidence is falling. So if you really want to see a period where gold is going to outperform the stock market, then what you want to have in order to achieve that is you want to have falling consumer confidence. I don't see the signs that that's going to start happening anytime soon, but maybe if there's a change in the political situation in Washington, D.C., or some other phenomenon that happens, war breaks out or major trade war, something else like that, that starts to shake consumer confidence, then you can start to see gold outperforming the stock market. We're not seeing that turn happening just yet, though.
Excellent. Excellent answer. Do you have another question there, Aaron?
I think we've all been talking about how September was really better than expected seasonally. Generally it's kind of a depressed month. And it didn't turn out to be so bad, at least so far. So should we expect a bad October? Should, that concern us? And I think you touched on it with the presidential cycle, but.
Well, there's at least two ways to think about that. If you see a period where it's supposed to be weak and it's acting strong, then that's a sign of strength. And strength tends to beget more strength. The question, though, is have we taken the strength that was supposed to come in October, November and pulled it forward and eaten our dessert first in the summertime? And that's a question I'll have a perfect answer for in a couple of months for you. So, but we can still use the seasonal pattern for interesting purposes by noting that the dance steps of the minor parts of the pattern are still showing up when they're supposed to, with about a 1 week lag. So I'm not very positive on the stock market for at least the next week or so till we get about to October 1st. I have an important bottom signal from other work that says that this September 24th seasonal pattern bottom should come in around October 1st. And then we can muddle around a little bit and start trending higher. As we start to see the shape of the midterm elections firming up, whichever way it's going to go, once we start knowing how it's going to go and we can factor it in, then it becomes less of an unknown risk and more of a certainty that people can plan for. Like I said, it doesn't matter how it's going to go as much as knowing how it's going to go.
Yeah, I would just add to that, looking back since 1950, which as far as I go back on my analysis, the month of October has risen 62% of the years since 1950. There have been 30 months where September's gone higher and 37 months where it hasn't. And during those 30 months when September has gone higher, October's gone higher 60% of those months following. So in other words, it doesn't seem to have that much of an impact on what we typically see in October based on September being strong. Now, again, there's so many factors that go into this. I don't want to just make a blanket statement and say, well, chances are October goes higher. I'm going to pay attention a lot to the technicals and what all that's telling me. But I didn't see any statistical data that would support the fact that September went up and so therefore October should go down. I didn't find anything like that. Any other questions, Aaron?
Nope, that was pretty much the majority of, when you kind of put them all together. Let's see. Actually, here's one that just came in. Looking at the silver chart, could the emerging markets down move, or it says, okay, could the emerging markets down move and potential up move you are showing support the move in silver you are expecting? And I think that kind of is wrapping up what you just said, but.
Yeah, Tom touched on the dependency of October versus September. If September, then October, and it doesn't really work out that way. I don't think that trying to combine if silver breaks this downtrend, then what does emerging markets do? I don't think that there's a dependency there that makes it work in a reliable way. Their correlation is much more random and not tightly correlated. So I don't think you can form an if-then statement from what you're seeing.
Always great having you on here, Tom. Thank you so much for stopping by.
Thank you, guys.
All right, there he goes.